Hello, my name is Hugo Reyes. I'm doing this video for my class General Finance, and I'll be talking about stock valuation today. This is the individual presentation. I'm part of Team GT, Great Time Team. I want to say that it's been a great class, even through all the circumstances that we have been going through. I've learned a lot about finances that I didn't know before, and I had a great team, which I appreciate a lot. I'll be talking about chapter 8 in the book, stock valuation. And stock valuation is the process of determining the intrinsic value of a share of common stock of a company. We have learned that companies have a common stock. They have shares that people can buy, and there are some companies that are on an exchange type of platform where people can buy and sell shares. So we're talking in this chapter on how to determine the value of a stock on a company. How much will I pay for those shares? How much are they worth depending on the dividends that the company pays quarterly in the year, depending on the revenue that the company is making, how much money is that company making, how much are they selling every year, how much dividends are they paying, and how much we think that stock is gonna be worth in the future. So all those factors come into play to determine the current value. How can we evaluate how much is that? So the purpose of stock valuation is to find the value of a common share which is justified by the company earnings and the growth potential. That's very important too. It's thinking, okay, how is this company gonna grow in the future, because that brings a lot of value. And then identifying all those things allows to see if a stock is undervalued or overvalued. Share of common stock is more difficult to value than a bond for at least three reasons. Because a common stock, they don't promise cash flows known in advance. It all depends on the sales. And if you can have a projection and an estimate, you'll never know for sure until the time is passed and you can evaluate, okay, how much did I sell? Second, the life of the investment is essentially forever, since common stock has no maturity. That's different from a bond, because on the bond, you know when it matures and when it's going to pay back that debt. And third, there is no way to easily observe the rate of return that the market requires. So for those three reasons, it's more complicated to evaluate a stock, but we'll see that there's some factors that we can play with so we can come to an estimate. Cash flows. Cash flows from owning a share of stock come in the form of future dividends. So there are companies that pay dividends every 4 months. They pay to the owners of the stock, they pay a dividend. So it is possible to calculate the present value of all the future dividends and thus come up with a value for the stock. So there are some formulas that they tell you, okay, if you have a company that pays dividends, you can calculate the value of that stock, adding the dividend is the cash dividend paid at the end of the period, plus the price that you think that stock is gonna have in the future, let's say in a year, and you divide that by 1 plus the required return percentage in the market of the investment. So basically what that is saying is, like, if you want to know how much it's the value right now that you will pay a fair value for the stock, you take the dividend they pay, how much is that stock gonna cost in the future, and you divide that by the percentage rate that you wanna, the return that you wanna have in the future. So we have different type of stocks. We have growth stocks, and this brings a case where some companies, they don't pay dividends right now, and you think, well, what do they give to the investors? So some companies, they just take all their revenue to reinvest in the company, so the company grows even more. So the investors of those type of company, they don't get dividends, but the price of the share is gonna keep going up in time. So they have their money growing there, and even if the company is not currently paying dividends, um, they will at some point in the future, um, after they reach the goals that they have, they grow what they want to grow, they pay dividends in the future. So the investors right now, they don't get dividends, but the price of the share is gonna keep growing in the future. So those are growth type of stocks. Um, then we have there are a few very useful special circumstances under which we can come up with a value for the stock. What we have to do is make some simplifying assumptions about the pattern of future dividends. That's a key factor. The dividends, how much are they gonna pay on dividends? And we have three cases about the dividends. We have the dividend that has zero growth rate, and that means that the dividend is fixed. They pay always the same amount, always the same percentage. We have another type that is the dividend grows at a constant rate. So that'll be, okay, every year the dividend goes a little bit more percentage. And the third case is when the dividend grows at a constant rate after some length of time. So it's not a constant increasement all the time, but it can be, something that varies on time. So we have the zero growth, the constant growth, and non-constant growth. Another topic that we can see in this chapter is that the owners of shares on common stock in a corporation, they have rights. And part of those rights that the investors, the owners of those shares have, is that they can vote to elect corporate directors. Voting in corporate elections can be either cumulative or straight. Most voting is actually done by proxy, and a proxy battle breaks out when competing sides try to gain enough votes to have their candidates for the board elected. So what this is telling us is that all the owners of the stock come up together once a year, twice a year, depending on the constitution of the company, and they can vote for the board of directors. Who's gonna be the CEO? Who's gonna be leading that company? Because the owners, they come out together, and by election, whoever gets the most number of votes, those will be the members of the board, and they will take the lead of the company. Also, we see that there are preferred stock, and so in addition to common stock, some corporations have issued preferred stock. The name stems from the fact that preferred stockholders must be paid first before common stockholders can receive anything. So preferred stock has a fixed dividend. This is like a more type of expensive stock at the price of the share, but they have some privilege. They get paid first on the dividends, and they have fixed dividends that get paid constantly. And the last point that we're gonna talk about is about the two biggest stock markets in the United States, which are the New York Stock Exchange and the Nasdaq. And we've seen that a lot in TV and the news all the time, because those are the markets where the stock is traded. So those are the places where the big companies are listed there, and this trading happens there. Someone is selling those shares, and someone is buying. So this trading of shares goes there, and the two biggest one are the New York Stock Exchange and the Nasdaq. Some companies are listed in one, some in another. Nasdaq, it's more like technology focused, electronic, and New York Stock Exchange is like the classic and the oldest one, where like the biggest companies in the United States are listed there. So this is a summary of my chapter and how do we do that stock valuation. I hope I'm explaining myself and explaining what I have learned from the chapter. Thank you very much, and thank you for trusting in us and helping us through this class the whole semester.